In just the last couple of weeks, mortgage rates have shot up from about 3.1%, where they had been hovering for a couple of weeks, to over 3.5%, which is the highest they've been in over 22 months. Listen, we all knew this was going to happen, but man, that has escalated quickly. Rates have gone up much faster than I was expecting them to, and it has caused one of the major indicators I like to follow to measure the health of the housing market, housing affordability. It has caused it to enter some concerning territory. And listen, I don't want to be alarmist because frankly, I am not one of those people who thinks there is some imminent crash about to happen or even that prices are going to go down anytime soon. But what's happened to affordability in the last couple of weeks is, to me, the most important metric to watch in 2022. So stick around for this one because trust me, you want to understand housing affordability. It is a vital indicator of housing market health, and it is going to play a big role in what happens to the housing market and your investments over the next couple of years. What's going on, everyone? This is Dave Meyer back again. Thank you all so much for joining me today. Before we jump into today's topic, please make sure to give us the old thumbs up. And if you want more content just like this, make sure to follow me on Instagram at The Data Deli. And with that, let's talk housing affordability. You probably already know this, probably pretty obvious, but affordability is a metric that measures how easy it is for a homebuyer or an investor to afford the average home in the US. And affordability has a few components to it, but the three most important ones are: one, the median home price in the US, because of course, how much a house costs dictates how much you are going to spend on it. Two is interest rates, because interest rates determine the cost of debt and how expensive your mortgage is going to be, relatively speaking. And third is the median income in the US, because of course, while interest rates and home prices dictate how much you're going to spend, the median income also dictates how much money you have coming in from your W-2 or whatever job you have. And right now, all three of these factors are going up. First, we all know that the median home price is up more than 15% over last year, which of course makes homes less affordable. If they are more expensive, the average person can't really afford as much of them. And as I mentioned at the top of the show, interest rates are also rising. Specifically, they have gone up 45 basis points in the last few weeks, which obviously makes homes less affordable. Just as an example of how interest rates impact affordability, if you were to put 20% down, the most common amount down payment, on a $400,000 home, your mortgage payment would go up about $70 per month or $840 a year. So those two factors, home prices and interest rates, are going up and making homes relatively less affordable. Luckily, at the same time, the median income in the US has also been rising, which sort of counteracts the effects of rising prices and interest rates, but frankly, not enough. And that's what we're going to talk about today. The major measurement of housing affordability is tracked by the National Association of Realtors, also known as NAR, and just last week it fell below 100. And this is an index, and what the index falling below 100 means, in simple terms, is that first-time homebuyers with the median income don't have enough income to qualify for a mortgage on a median price starter home. Specifically, this data shows us, and I should mention that this data is also according to NAR, so big credit and thanks to them for sharing. The data says that the median family income of renters in the 25 to 44-year-old age group is about $57,000. While the amount needed to qualify for a starter home is $62,000. So something's not working here, right? The amount you need to qualify is more than the median income. So this is what I mean when I say that the housing market is starting to enter precarious territory when it comes to housing affordability. Even though housing prices have been going up and up and up over the last couple of years, the median first-time homebuyer could still qualify for a mortgage for those prices up until last week. But now, because rates are going up so quickly, fewer and fewer people are able to qualify for the loans they need to make these purchases, and this is likely to cause demand to drop. And as we all know, if you've studied even basic economics, when demand drops, prices tend to drop too. And listen, I need to caveat all this and just say, First, this analysis is just for first-time home buyers and for medium-priced properties. It doesn't factor in repeat buyers or investors or BlackRock and all the Wall Street funds. Doesn't factor in any of that. But it is something to keep a really close eye on, because if affordability continues to decline, home price growth is likely to slow significantly, and yes, it could even reverse. And to that point, I do think affordability is going to continue to decline. Listen, we know the Fed could raise rates 3 or maybe even 4 times in 2022, and the market is starting to price those future rate hikes into current day mortgage prices. Bond yields, which are also another major indicator of mortgage rates, probably the best indicator of mortgage rates, are also starting to rise. So mortgage rates, they are extremely likely to keep rising beyond where they are today. And that's going to happen during a time when home prices will likely continue to rise, at least for the next few months. Let me just explain that, because that can seem counterintuitive based on everything I'm saying. One, we know that supply is really, really low right now, and that is going to keep putting upward pressure on home prices. And then secondly, demand, despite interest rates going up, is actually going up as well. There is a survey by the Mortgage Bankers Association of America that measures how many people apply for a purchase mortgage each week, and it's actually gone up each week as rates are rising. And that's just because people realize that rates are going to continue to rise for years to come, and they want to lock in those low rates right now. So again, this could create this kind of weird situation where interest rates are going up, but we are also seeing home prices go up at the same time, which is sort of a 1-2 punch for affordability, and affordability is probably going to keep going down over the next couple of months. Now, what does all of this mean? Because of course, affordability on its own doesn't dictate what's going to happen with housing prices. We know that supply is severely constrained, and demographics are very favorable right now for housing market price growth. So to me, what it all comes down to is the same thing that I've been saying for months. It is a matter of how fast rates rise and how much they wind up rising. If rates on mortgages rise really fast, it is going to cool the housing market a lot, or even send prices sliding backwards. If they rise slowly, the market can adjust to rising rates, and home prices can keep going upward, albeit at a slower pace. So far, rates have risen faster than I was expecting, but demand hasn't dropped off. And as I just said, demand is up. More people want to buy houses right now, even with rising rates, and because they want to lock in low rates before they rise even more. And let's just remember, and I know I say this all the time on the show, but mortgage rates, even at 3.5%, are incredibly, incredibly low. And I cannot stress it enough. Is it all-time lows? No, it is not. And we're not going back to 3.1 or 3% interest rates, in my opinion, anytime soon. But will you be very happy with a 3.5% interest rate 10 or 20 or even 30 years from now? There is absolutely no doubt in my mind. I think you have to take this all into consideration, that although affordability is declining, and it is something that I personally am worried about and going to keep an eye on, I don't actually think that we're going to see prices flatten or decline anytime this year, because demand is still going to be really high, because interest rates are still good from a historical perspective, and supply is really constrained. As I said, it is all a measure of how fast it happens. So if interest rates do continue rising at this rapid rate that we've seen over the couple of weeks, I will definitely change my opinion. Because after all, what I'm saying right now is just my read of the data as it stands right now today. And things are changing really rapidly, and I am going to be continuously updating my outlook in the coming months. And as I do, I will make sure to share my thoughts with all of you as we get more economic data to help guide our investing decisions. Thank you all so much for joining me. I am Dave Meyer, and as always, if you want to ask any questions or have any thoughts about this video, please feel free to reach out to me on Instagram, where I am the Data Deli, and I'll see you all next week. Thanks.